Amit Khurana is joining us now to talk more about markets and the way they are looking at the markets at Dolat Capital. Amit, afternoon. Thank you so much for your time. Remember last time when we were talking, you were slightly cautious on the market, and by mid of March, that caution actually played out. However, it was short-lived in the market rebound. What's your current prognosis of the way earnings seasons are panning out? Did you request your all the clients to buy that dip, or still they are on the sides?
Yeah, thanks, Ajay. I think, the correction did play out, which we were anticipating, but the depth of it and the breadth, I must say, did not come as much as one would have wished for, because that would have made the attraction, I know the valuation is more attractive, but this is classical markets which get every dip gets bought into. Now, the earnings season has not really started on a strong note, I must say, because most of the numbers till now do not suggest a very strong either a performance for Q4. But even from the commentary perspective, when you look at, I would probably call it mixed. It's not negative, but it's not definitely something which can lead to an earnings uptick. Whether you look at IT services, whether you look at some of the financials which have reported, there are small tweaks that you're doing here and there, but nothing directionally which leads us to an upgrade of the view on the market per se. So in that environment, how do you navigate the next few months? Our take continues to be bottoms up, stock picking as a preferred mode, and look out for names either showing signs of turnaround or names which have visibility. I know even though you may have to pay little bit of a premium on the valuation side, but then the momentum continues to be supportive for those sectors or stocks, continue to back up those. And this is a very divergent market, which tends to give it much higher premium multiples for names which are performing, and tends to beat down sometimes unfavorably names which are not showing the desired numbers or the growth pattern. So largely, I think bottoms of market is what our take is for the first half of this financial year, and that we stick to that view as of now.
And talking about bottoms up, take a look at Exide and Amara. It's again seeing quite a bit of rise at this point of time. Exide, I think, is up a solid 5%, and bulk of that move has happened in the last few minutes itself. And let's pull up Amara Raja batteries too. That stock is in focus. So both of these counters actually doing quite well. Amit, wondering what's your view is on these battery companies, because they have seen a solid run in the last 1 month.
Well, yes, I think if you look at the slightly longer time frame, they have outperformed the pack, the sector, the market by a very, very wide margin. And I think a part of that was, of course, the tailwind trade that we got to see when the raw material cost normalized. And then, of course, you had the follow through demand playing out well. And now you have the new battery storage as one of the drivers of the valuation. So I think structurally, these companies will benefit from these new businesses which are emerging. But I think the discounting of those as of now seems pretty well in the valuations. In fact, from the overall auto ancillary perspective, we believe the manufacturing, the other segment for OEMs is better placed versus the battery as of now.
Right. Amit, just wondering how to navigate within the IT pack right now. I mean, sure enough, the commentary from the big boys continues to be still elusive and, pretty unclear. But that's not quite the case with the TechM, for instance. Yes, they're talking about FY27 projections without a clear roadmap. But would you say that, other than TechM, this could perhaps prompt you to start nibbling into a completely unloved, under-owned sector right now?
Well, it's not unloved really, because the mid caps have been performing reasonably well, and that's where our concern is, that the PEG multiples that you are paying for some of these franchises, some of these names are pretty rich. So our take has been that even if one has to play on IT, one plays on the large cap, and that again is very stock specific. So for example, HCL Technologies is one of the names that we've liked that has done reasonably well. Mid-cap concern still is that even for 8-10% or even low double-digit growth visibility, you are paying 32 times, 35 times, which does not really seem to be very attractive to us. Now, let us not forget that the environment probably will worsen over the next couple of quarters. This is what the commentary seems to suggest. Now, how will these mid-cap companies navigate? One has to see. So our take on IT has been very specific on the stock side. In fact, rather than play the IT, we played more on the digital side of the themes, wherein some of the domestic digital themes have played out much better if one were to expand IT into a larger basket. But pure IT services, we are avoiding mid caps very clearly and preferring large caps on a stock specific basis.
Kunal and Nuresh are also joining us on the show. Kunal, some of the interesting counters which are very quiet for a long time have seemed to have woken up. For example, Havells and Ashok Leyland. Any of those charts you have on your radar?
Yeah, Havells is something which looks attractive, Ajay, and I think with Voltas breaking out of that, 1000 and 1200 and 1300 triple resistances for itself, I think Havells has also managed to come out of a major phase of consolidation, zone of underperformance for itself. So I think that's something which looks attractive. Now I think trading closer to 1630, 1640 plus mark, I would probably believe that this momentum should carry on and continue. So what has happened is today, many of these stocks have opened with a gap up. Havells has created that gap up support, I think just around that 1500 odd mark, 1500, 1520 range. So I think that should now act as a very strong support for the stock. There are other names which have also made a very strong comeback. From the comeback theme as such, Sun TV is something which in Biocon, Sun TV, these are the two names which have been earlier bullish on. These stocks have been showing some excellent signs of recovery for themselves. So I would probably pick from these two stocks as well. Sun TV as well as Biocon, both of these stocks are looking fairly attractive. And I would believe that this could be a very strong indication of a momentum shifting towards many of these other underperforming names and not the traditional financials, banking, etc., which I believe could probably act as a drag for some more time.
Point taken. Just wanted to highlight the numbers coming in from Shriram Finance, and it's bang in line with expectation as far as the profitability is concerned at 1950 crores. The NII too has come in at 5,336 crore, a little better than what we were expecting at 5,106 crores. Even with respect to AUM, it's increased by 21% on a year-on-year basis. It stands at around 2,24,861 crore rupees. So broadly in line with expectation as of now. In terms of the other details, where I'm just looking at the grocery assets as well, that's also 6% kind of number that we have seen on a year-on-year move. And overall, the number seems stable. We'll try and get more details, but the stock has been pretty much stable at that 2.5% cut mark. We are not seeing any big reaction either on the upside or downside for Shriram Finance at this point of time. But shifting focus to some of the other big movers right now, we of course have Concor, which is doing quite well. Hoodco is in focus, and then Dixon Tech has managed to gain 6% apart from Havells India as well. What's your take, Nuresh, on the likes of Dixon, Havells, Concor?
So Concor is something which I've been recommending for quite some time as the only one which has not yet caught up with the whole PSU basket. Finally, the stock has hit a new all-time high. And even if we look at it from the perspective of an all-time high, the previous high was around this 1,030 mark, which was back in February of this year. So a fresh breakout here looks good for a target price of 1,400 in the medium to long term. Have a positive bias here. Then looking into Havells, this is interesting because what we've seen over the last few months is one by one consumer appliances names have started breaking out. It started off with Voltas. We've seen some recovery in Crompton Consumer. And now Havells, which was the first one to break out, I had not seen a sharp momentum after that breakout above 1450. Consolidated between 1450 to 1580. Finally, today that has broken out. This opens up an upside towards the 1900 mark in the short to medium term.
And small cap shake-off, which transpired in March, perhaps started with the overheated railway names, some of the defense names as well, where some of the weaker hands got shaken off. And now again, they've more than recovered all of their March losses. Wanted to understand whether you're constructive and continue to be so in the long haul as well on the railway and defense names.
Sorry, is that for me?
Yes, Amit, for you.
Yes, yeah, sure. So yeah, I think the story does not change in the longer term. Essentially, the market tends to sort of give too much of a premium multiples in the near term. That has its own sort of way to correct, either in terms of time corrections or in terms of price corrections. Ideally, a combination of both. I think the overall view, structurally speaking, continues to be extremely positive on domestic capex stories and the spenders, so to say, because the kind of support that we would be expecting, hopefully when the new government takes office, whether it's a current ruling coalition which comes back or whosoever comes back eventually. But I think the momentum for some of these businesses remains very much in place. And remember, one very important part is that the balance sheets are much stronger than what was the case a few years back. And that I think is very, very supportive of the valuations continuing to be higher than what we would ideally want them to be.
Shriram Finance is recovering very smartly from days lows because the provisioning number is not worsened. In fact, it's just flat. The 27% revenue growth without worsening of provisioning actually perhaps is something which the street is liking. From 23.40, almost $100 recovery coming in, breaking into the green. We'll get a review also going on that name very shortly, which is now a nifty participant, by the way. But Nuresh, look at the charts of Affle India. For the last 4 quarters, the stock has been punished because of weak earnings and almost halved from recent top. Today, it's come back. Is the move backed by volumes, and how does the chart setup look like?
So still would be a weak one, given that it's still a one-day price action. If you look at it over the last few months, it has made tops around the 1300 mark multiple times. On the bottom side, at least 1000 is the support which it has held down for the last 6 months. So for now, 1200 is the first resistance. Next is at 1300. The trend still remains weak. Would be too early to call a trend change out here.
Before we let you go, any fresh recommendations from the House of Dolat, or which are those high conviction buys that you are probably recommending and putting in the buy list?
Well, it will be up for review post the earnings season. We haven't changed that drastically. I don't see a very, very significant change. One sector which is up for debate at our end is chemicals, which has shown some evidence of pricing having bottomed out. And depending upon the volume visibility that we get to hear in the earnings commentary and the overall themes that work out at the global front, we'll probably take a review at that. So that could be one candidate for a potential upgrade from our side, but that's not the case as of now.
Okay, Amit, good to have you on the show. Thanks as always for taking the time out.
If you like this video, then like, share and subscribe to ET Now.